$4.5 trillion. That was Nvidia's peak market cap in 2025, larger than the GDP of most countries, a single chipmaker worth more than entire economies. In 1999, the dot-com bubble inflated on promises of a future that hadn't arrived. Pets.com webvan, billions vaporized. But here's the twist. Nvidia's products are real. They power the AI revolution. Their data center revenue is staggering. Yet in 2025, the company lost $600 billion in market value, more than the GDP of Sweden. A 17% drop, a stark warning. Meanwhile, AI-linked stocks surged 4,000%, outpacing even the dot-com era's wildest gains. So the question hangs in the air. Is this a repeat of 1999-2000, or is this time different? The answer is surprising. We'll trace the money, the hype, and the hard numbers to see if history is rhyming or just repeating. In 2025, the AI frenzy feels eerily familiar. The comparison to the dot-com bubble of 1999 to 2000 is impossible to ignore. Nvidia, the chip maker at the heart of the revolution, hit a peak market cap of $4.5 trillion, larger than the GDP of most countries. Then it lost $600 billion in a single day, more than the entire economy of Sweden, gone, a 17% drop, a stark warning for anyone watching. But the numbers don't stop there. Hundreds of billions are pouring into data centers. Yet the dot-com crash was fueled by Y2K-induced overspending, fraudulent capital expenditures, and speculative IPOs. Today's boom rests on real technological breakthroughs. The AI market is growing rapidly, not just hyped. Still, valuation is the elephant in the room. When a single company's market cap dwarfs entire nations, you have to ask, is this sustainable? The demo is stunning, but here's what it didn't show you. The stakes are higher than ever. But how much of this is real growth, and how much is just speculation? The dot-com crash didn't happen by accident. It was engineered by three forces: Y2K-induced overspending, fraudulent capital expenditures, and a flood of speculative IPOs. Companies with no revenue, sometimes no product, went public, and investors threw money at anything with a .com suffix. When the music stopped, trillions evaporated. Now look at AI. The technology is real. Large language models work. Autonomous agents are shipping. But the spending? Hundreds of billions of dollars are pouring into data centers, concrete, chips, cooling systems, before most of those centers have a clear customer. That smells like the late 1990s. Yet the underlying business models remain unproven. Fraud hasn't surfaced at scale, but the pressure to show returns is immense. When a single company like Nvidia can lose a fortune in weeks, the fragility is real. The question isn't whether AI will change the world. It will. The question is whether the market has priced that change 10 years early. The answer lies in how AI spending compares to the dot-com era's reckless investments. Subscribe to stay ahead of the next tech bubble. You're standing at the edge of a $4.5 trillion peak. That's what Nvidia was worth in early 2025, larger than the GDP of most countries. Then the drop came. $600 billion vanished in weeks, more than the entire economy of Sweden, gone. A 17% haircut. A stark warning for anyone who thought the AI rally was invincible. But here's the twist. The dot-com crash wiped out companies that had no earnings, no product, no revenue. Nvidia has all three. Its chips are the engine of the AI revolution. The dot-com bubble was fueled by Y2K panic, fake capex, and IPOs that never delivered. Today's spending is on data centers. Hundreds of billions of dollars poured into concrete and silicon. Real infrastructure. So is the drop a warning or a correction? The market is asking a harder question now. Can the revenue catch up to the hype? If AI adoption slows, those data centers become stranded assets. If it accelerates, today's prices look cheap. The real test is whether AI's technical advancements justify these valuations. Hundreds of billions of dollars are being poured into concrete and steel. Data centers rise from the desert floor like a new industrial revolution. But here's the question no one wants to answer. Is anyone actually using all that computing power? In the dot-com era, companies laid fiber optic cable across the ocean floor. They built server farms for a future that hadn't arrived. The mantra was simple: build it and they will come. They came, eventually, but not before the bubble burst and billions evaporated. Today's AI infrastructure spending dwarfs that era. The scale is staggering, yet the revenue from AI products remains uncertain. Many companies are racing to deploy models, but the killer app, the one that generates sustainable profit, hasn't materialized. You see the same pattern: massive capital expenditure justified by future promise, not present demand. The difference, this time, the technology is real. AI can write code, diagnose diseases, generate art. But real technology doesn't guarantee real returns. The dot-com crash didn't kill the internet. It killed the companies that overbuilt before the market was ready. The spending spree raises a critical question. What happens if the bubble pops? The dot-com boom sold dreams on a dial-up connection. Companies with no revenue, no product, and no plan went public. And investors bought the hype. B&2K panic had fueled a spending spree on servers that sat idle. Fraudulent capital expenditures, padded balance sheets. When the music stopped, trillions evaporated. AI is different. The technology works. You can open a chatbot and watch it write code, diagnose an X-ray, or draft a legal brief. The breakthroughs are tangible, not a promise of someday, but a tool delivering value today. The AI market is growing rapidly, not just in stock price, but in real adoption. Companies are integrating these models into their core operations, cutting costs, accelerating research. But here's the uncomfortable truth. Valuation is the biggest piece of evidence that we are still in a bubble. The dot-com era had revenue-less companies trading at absurd multiples. Today, even profitable AI firms trade at multiples that would make a 1999 analyst blush. The underlying tech is real, but the price tag may still be a fantasy. Therefore, the question isn't whether AI will change the world. It already is. The question is whether the market has priced in a decade of growth in a single year. The final piece of the puzzle is whether today's valuations are sustainable. The parallels to 2000 are undeniable. But here's what's different. The dot-com crash was fueled by Y2K-induced overspending, fraudulent capital expenditures, and speculative IPOs with no revenue. Today's AI boom rests on substantive technological advancements. The market is growing rapidly, not just hyped, yet valuation remains the loudest alarm. Nvidia lost $600 billion in market cap, more than the GDP of Sweden, in a single 17% drop. That's a stark warning for investors who thought the ride would only go up. The question isn't whether this feels like 1999. It does. The question is whether the underlying technology can outrun the speculation. AI is already embedded in products you use daily. The dot-com bubble had pets.com. This one has tools that write code, diagnose diseases, and drive cars. But hundreds of billions are still being spent on infrastructure that may take years to pay off. The answer may define the next decade of tech. So here's the answer. The AI boom is not the dot-com crash, but it is a crash waiting to happen. The technology is real. The dot-com era had pets.com and fraudulent Y2K spending. Today you have Nvidia's chips powering models that actually work. The AI market is growing rapidly, not just speculating. Yet valuation tells a different story. Nvidia hit a peak market cap of $4.5 trillion, larger than the GDP of most countries. Then it lost $600 billion in a single day, more than the GDP of Sweden. A 17% drop, a stark warning. Hundreds of billions are pouring into data centers. The infrastructure is real, the hype is not. The lesson: real technology does not guarantee rational prices. The dot-com bubble burst not because the internet was a fad, but because investors paid for a future that took a decade to arrive. AI will change the world, but the market is pricing in that change overnight. When the correction comes, it won't be because AI failed. It will be because the gap between promise and profit grew too wide. And that gap is something you can measure. You can feel it in every earnings call, every overhyped demo, Next time, we look at the hidden monopoly behind the chips, the one company that controls the bottleneck for the entire AI supply chain. You won't see it on the front page. This is the monopoly matrix, where business meets the future.